Axon announced earnings after the market closed on Monday, and the market actually didn't have a really good reaction, despite the fact that I thought results were really positive. The company also announced another acquisition that I think could potentially expand its addressable market in a pretty big way. Not going to be a big impact on the company this year if the deal does close this summer as they expect, but you can really see the vision for Axon taking shape beyond what we already know today, beyond tasers and body cameras. They're now moving into drones and becoming more of a intelligence hub for law enforcement overall. So I think it's a really interesting vision for the company. Probably makes the opportunity much, much larger, but it's also going to probably bring along more competitors as well. So I want to dig through the results and what investors were disappointed by, why the stock is down, and that comes down to the bookings that happened in the first quarter. But hopefully this will give a full overview of the earnings report and everything you need to know about the stock. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right to the report. This is the first quarter report, and you can see some of the high level numbers here. Revenue, $461 million, up 34% year over year, and they also increased their outlook. Maybe didn't increase it quite as much as investors were expecting. Management basically said in the conference call that they just didn't want to get out over their skis from that perspective. So we'll go through some of these numbers, but I'm going to jump around a little bit and kind of show what these acquisitions that they're making as well. Talked a lot on both the conference call and in the shareholder letter about artificial intelligence, virtual reality, which they've invested a lot in, and drone as first responder, DFR. This is kind of a new concept to Axon, but comes back to the acquisition that they made of a company called DeDrone. The other big thing was an increase in capital expenditures related to demand for Taser 10. Again, this is one of those things where management is investing money to automate some of the manufacturing process. So these are things that need to be done as you're increasing your production, but the impact is going to be less cash flow now in return for more cash flow and more growth in the future. This is always the balance that companies have to make, and Axon has often chosen to put off that profitability, and for good reason. They've had phenomenal growth rate, and we see that again in the first quarter, but this is part of the market's negative reaction is because they're maybe looking for a little bit more cash flow this year. I want to skip to the DeDrone acquisition because I think this does play into the strategy of what the company is trying to build in this huge ecosystem that really runs law enforcement agencies. So this is what they call a strategic ecosystem expansion. They did not give the terms for the acquisition of DeDrone, and they did say that there was going to be very little impact this year on the revenue side, but there would probably be a negative impact on adjusted EBITDA and the profitability of the business. So probably a loss coming from DeDrone for at least the foreseeable future, but we'll see how this grows. I do want to go through DeDrone's website just a little bit. This is not really a company that's built for some of the applications that Axon is saying they're going to be using this for. What Axon is saying is they're going to use the DeDrone technology to kind of be the first responder, if you will. So you would have a network of drones that could just be launched if there's some sort of incident where first responders are needed. Then the people who are organizing those first responders can say, okay, we need somebody here. Maybe there's a threat there. Maybe there's need for an ambulance over here, so that you have a little bit more information as you're coming onto the scene and everybody just isn't coming in blind. But the way that the company was designed is saying, hey, let's stay ahead of the drone threat. So in war zones and things like that, drones have become a real threat vector, and DeDrone was designed to combat that. So I think this is one of the kind of strange things. There's buying a company that has technology that's probably applicable to Axon, but they're going to use it in a little bit different way. Just looking at the industries that they could potentially serve, I think this is where you see Axon is saying that this will increase the potential market for Axon as a company getting into the drone business. And this is the reason why. DeDrone is designed for airports, correctional facilities, data centers, enterprises, federal government, and military. So a lot of these places are areas where you're not necessarily going to sell body cameras or tasers, but maybe an airport, it would be beneficial to have the infrastructure to be able to react if there's some sort of threat from drones. So that's where I think there's both a strategic advantage in the products that Axon's already making, and then potential to increase the addressable market and the number of customers that they're serving. They also recently acquired a company called Fusus. They had a strategic partnership with them, but this is really where you're going to have the hub for first responders. So Fusus One, for example, is a map-based interface that combines the private and public video streams into a single feed, increasing situational awareness. So again, from a really high level, just trying to get into the infrastructure of first responders and that control center aspect. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So that DeDrone business and Fusus are going to be more visions for the future, not necessarily financial impacts today, but let's look at the financials from this quarter. You can see that Axon Cloud and Services revenue was up 51.5%, just a phenomenal growth rate there. Sensors up 14.3% in the quarter, $205.5 million. The gross margins in excess of 70% in the cloud and services. That's exactly what you would expect. Sensors and others, still a really high margin on an adjusted basis of about 47%. Tasers, always a much bigger business than I think people give Axon credit for. $178.7 million in revenue, and that was up 33% from a year ago. Adjusted gross margin 61.8%. So phenomenally profitable business making tasers, and like I talked about, they have had to increase their volume of the Taser 10 because they've had so much demand for that product. This is where there's a little bit of disappointment for investors. And what Axon has done over the past couple of years is really move to a more subscription model where they're signing contracts that are often 10 years in duration, and a law enforcement agency will say, okay, we'll pay you this amount per month, and then you're going to provide all these cloud services, and then periodically you're going to update the hardware as well. So usually includes body cameras and tasers in that. And that's where you get this growth in future contracted revenue. You can see that March 31st, 2022, $4.8 billion. That was up to $7.1 billion at the end of 2023. But here's where things are a little bit disappointing. Only $7.0 million in total contracted revenue at the end of the first quarter. That means there wasn't a lot of deals that were actually closed in the first quarter. They talked about that a lot on the call. This is kind of a seasonal thing. Budgets often don't end in the first quarter, and that's usually when you have the ability to sign contracts, is when there's some sort of deadline approaching. So that is a piece of that, but net revenue retention was 122%. And recurring revenue was up to $825 million in the quarter. So I think the way that you can read this is a bunch of deals got signed, particularly in the fourth quarter of 2023. Things slowed down a little bit from a signing perspective in the first quarter. But we may be at a point where Axon isn't going to grow those bookings quite in the way that it was a couple of years ago. So that's really what the market is trying to balance. And when you have a stock that's expensive as Axon is right now, you really need to hit these numbers out of the park. And so that's why you see a disappointment from the stock perspective. Outlook, like I said earlier, management is not raising guidance in a huge way, given the 30% plus growth rate in the first quarter, just expecting approximately 26% annual growth at the midpoint. Given this guidance range, expect adjusted EBITDA to be approximately 22% on a margin basis. And then still spending a lot of money on stock-based compensation. This is always something you need to consider with Axon because they do have a massive stock-based compensation plan, particularly for the CEO, but that's actually something that employees have been able to use in the past as well. So they talked about dilution being around 3% for the company. That's a very, very high dilution rate, offset by the growth rate. But if growth slows, then you're going to see more focus on that dilution from stock-based compensation. One of the challenges with Axon is what in the world do you do with this stock? I've held this stock for a very long period of time, starting to take a little bit of chips off the table over the past year or so. But the reason for that is it's such an expensive company. Just to give some of the multiples on a trailing basis, this is according to FinChat, the price to earnings multiple is 90. On a forward basis, the price to earnings multiple is 67. On a price to sales, enterprise value to sales multiple on a trailing basis is almost 15. That is the multiple that you would expect for a high growth software company. This is partly a software company, but it's also a hardware company. So by any metric, Axon is a very expensive stock. Now, also a very impressive company that continues to grow in excess of 25% every single quarter like clockwork. But is that growth going to eventually slow? That's what would end up pulling the stock lower, because if growth slows to 10 or 15%, which by the way would still be a phenomenal growth rate for a company of this size, it just doesn't justify that stock price. So that's why you look at something like bookings and it can be a disappointment for investors, because you start to worry that this growth rate isn't going to be in excess of 25 or 30%. It's maybe going to slow down a little bit. And if that happens, now suddenly the multiple that you would be willing to pay for a stock like this as an investor is probably a much, much smaller multiple than what we're paying today. So that's my only hesitation. This is one of those situations where this can be a phenomenal company and maybe not such a phenomenal stock, just given the price of shares right now. But overall, I think the quarter was really solid. The vision to add the control center infrastructure, drones to the ecosystem, I think these are all moves that are moving in the right direction. I love the business. I love the stickiness of the business. The price is just very, very high. And that's just been the reality for Axon for quite a while now. But what do you think about the results from Axon? And what do you think about Axon's price? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.